So are there some magic moving average numbers? Like when we talk about that, we're talking about time frame. Are there some magic ones or the right ones to use, so to speak, and or some better than others? And there may be some better than others, but there's no magic moving ones. Or moving average numbers. There's no magical numbers around that or average or special time frame numbers. Someone says they know the best numbers or whatever, you might be, or they have a great system, you might want to be a little skeptical of that. But there are some common time frame numbers that are used a lot and are talked about in the media and all that too. So you will hear these over and over again, and there's one that really kind of stands out as far as something that's very commonly talked about. So it's good to understand what's going on with those. They're not magical, but understand that they're maybe highly publicized, and then how that can actually impact our investments, our securities that we're investing in. So if we think about the one that's really talked a lot is the 20-day moving average. And the 20-day moving average stands out because 20 days equals 1 month of trading days if you look at a trading period. Now a 20-day moving average, it could be a 20-minute moving average or a 20-hour moving average. Again, the time frames you can set based on your type of trading, how often you're trading. A day trader would have minutes and maybe an hour or hours versus somebody who's like me looking more at a month of trading days. But it's well known and it's observed by the trading community. So people know the 20-day moving average, and it's almost a self-fulfilling prophecy, right? So because everybody's talking about, oh, something's happening, it's coming close to the 20-day moving average. So when a security, let's say, is trending, it's common that the 20-day moving average will work like a support line. Sellers will stop selling it when it's reached. This is actually very common. It's like, oh, it's coming to the 20-day moving average. We don't think it's going to cross it. We think that's going to be more of a support line. So sellers will stop reaching and selling, and it'll actually intentionally bounce off the bottom of that support line and start going back up. That's actually very, pretty common. Less common is when the 20-day moving average, works like a resistance line at the top, where buyers stop buying when it's reached, whether they're waiting for it, to reach at that top, and they're like, oh, I don't think it's going to cross the 20-day moving average, so I'm going to now stop buying because we're coming up a resistance level. Now, if your charting and stuff has actual resistance and support levels, that's another thing, and maybe this is reinforced. But I think there's a little bit of self-fulfilling prophecy where people just believe these things, and they're like, well, okay, I'm not gonna sell when it gets down towards the 20-day moving average, but and I'm not going to buy when it gets to the top because I think it might break through that 20-day moving average. So not a magic number, but understand this is what you might hear in the media when they start talking about a security approaching the 20-day moving average. Now there are other moving average numbers too, and other popular moving average numbers includes a 5-day, which is like 1 week of trading, and 50-day, 100-day, 200-day, and why are these popular, right? Well, they're popular because they're round numbers. They're not magic numbers in any respect. At least the 5-day, you could say, well, equals 1 trading week or something. But they're not magical in any manner. But it does give the financial news something to talk about, and maybe make up. I don't want to say make up, but talk about things that when these things interact together with these kind of popular moving averages, like the dreaded, drum roll, dreaded death cross. Have you ever heard of the death cross? It's a real thing, and I don't know if it's not a real statistical thing, but it's certainly something they talk about in the media. So a death cross is simply when the 50-day moving average crosses below the 200-day moving average. That's the definition of a death cross, right? 50-day goes below a 200-day moving average. So we would know that would be kind of like a sell type pattern or a bearish pattern. Now there's no statistical advantage over any other crossing pattern, and actually since it's got longer time periods of 50 and 200 days, you actually are experiencing more lag, as we know from our previous lessons. But traders recognize a death cross. The media talks about a death cross, so it might be a self-fulfilling prophecy that, oh my gosh, a death cross is happening. We need to be aware of this, that prices are about to really go down because we're going to cross this death cross, or the death cross just happened. So this is a terrible thing. Same thing with a golden cross. So the opposite is when the 50-day moving average crosses above the 200-day moving average. That means prices are going to go up. So some would say a death cross means a wider bear market and a golden cross means a wider bull market. It does mean that a shorter term moving average has crossed a longer term moving average, and we know that means something, and people trade on that, and we can trade on that. But there's no guarantee like, oh, okay, things are going to get bad or things are going to get really good, depending on your point of view. If we looked at it graphically, by the way, this is what it would be, right? It's you get your 200-day moving average, and you have your death cross when it goes below, and you have your golden cross when it goes above, right? So that's kind of how that all kind of works. So it's the same thing. It's just the concept of, again, there's no magical numbers with moving averages, but it can be self-fulfilling as far as in the news media. But one thing with moving averages, to think about is they're really good, powerful indicating tools. And you can use them in different ways. You can use them as a primary indicator. You could use them to confirm another indicator. You can use them when prices cross above and below lines. You can use them when two moving averages cross each other. There are different ways to use them and different ways to incorporate them into our trading strategy. And they're very established, very well known. So that means lots of traders are using them, so it can be a little bit more predictive that way too as well. So use them with other indicators, but moving averages can be a really, really great way to enhance or be a big part of your strategy in terms of technical analysis. Now later we're going to talk about how to build these strategies and things together, and how to pull these different things that you're learning about together into some coherent strategies and things, and also how to trade around these things as far as how much money to invest, all that. That's coming up towards the end. But for right now, understand that a moving average is an indicator, it's a tool, it's another tool in your toolbox, and it's a good tool to have, it's a good tool to use.